The latest rate hike by the U.S. Central Bank has widened the rate gap between the U.S. and South Korea to a new high, raising concerns over a possible increase in volatility of the $1 exchange rate as well as capital outflow. Our Moon Hye-ryeon has the details.
With the Fed's latest decision to hike the key interest rate by 25 basis points, the difference in key interest rates between South Korea and the United States has reached an all-time high. The FOMC announced Thursday that it had lifted its interest rate to the 5.25 to 5.5% range, bringing the gap between it and the Bank of Korea's rate of 3.5% to 2 percentage points. This is the first time in history that the rate difference between the allies has reached the 2 percentage point mark, prompting concerns over the impact this could have on the South Korean won-US dollar exchange rate and sparking interest in the Korean Central Bank's response. The won has been losing ground against the greenback, closing below the $1,301 rate at 1,275 won on Wednesday as a result of sluggish IT exports and the country logging a trade deficit once again in July. An increase in interest rates by major economies like the United States often leads to a devaluation of other currencies such as the Korean won, as investors are drawn towards more profitable investment prospects. The BOK has kept its benchmark rate at 3.5% for nearly half a year now, with its latest decision 2 weeks ago to maintain the rate for the 5th month in a row. Speaking at a central bank meeting on Thursday, Deputy Chief Lee Seung-un remarked that there is still a long way to go until inflation recovers to 2% and that further monetary tightening may be necessary despite the consumer price index slowing to the 2% range in June for the first time in 21 months. The central bank had previously announced that rate hikes to 3.75% may be possible amid inflation uncertainty, with its inflation forecast for July announced on Wednesday at 3.3%. He also said the central bank will closely monitor related market conditions by watching out for increased volatility in domestic and foreign financial markets due to changes in policy expectations. Finance Minister Chu Kyung-ho, also speaking on Thursday, said the government has plans to stabilize the domestic market.
The government will continue to strengthen resilience against external factors by bolstering the current account balance and other economic fundamentals, ensuring that South Korea's financial and foreign exchange markets are stable.
Moon Hye-ryeon, 아리랑뉴스.